All right, we're ready to get started. Thanks everybody for joining. So we're going to go through today our pilot experiment virtual meeting here. We're going to pick a couple of different topics as we go forward, but today we're going to look at the profit and loss, how to read your profit and loss. So for all of our retainer clients out there, obviously many of you will meet with Mike or myself on a periodic basis and we go through your financials. But we want to make sure that you have a general overarching understanding of this very important financial statement and what it means for your business and how to read it. So we'll dive in here. We go to start the slideshow. That would be helpful. All right, so what is on the profit and loss, or the P&L as we call it? In official terms, it shows basically as a record of the sales that your company brings in, any direct costs related to those sales, or cost of goods sold as we call it. It also tracks the general overhead expenses of your company. And ultimately, the sales less the cost of goods sold less overhead equals your net income, or your take-home pay. So, in layman's terms, the money you bring in less what it costs you to make that sale. Then you subtract out, your regular monthly expenses, your rent, all your recurring kind of subscriptions, and any other kind of general overhead expense, and that leaves the money that's left over. That's the net profit that you have as the owner to distribute to yourself in some form or fashion. So, like I said, after you subtract all those elements from the gross revenue, the amount left over is what you have to pay down your debt. So if you have business loans, this is the money that you will use for debt servicing to make those payments. It's money that you can reinvest into the business if you want to buy more equipment or supplies or additional office space. The other thing that's important is it's also the money to pay your taxes. So, when you look at that bottom line number of what net income your business has generated, it's important to remember that not all of that is yours. There's a certain amount that you should be setting aside for that eventual year-end tax bill. As you know, many of our clients, the majority, are either sole proprietors, or with an LLC, a single-member LLC, or S corporation owners. So in both cases, the taxes aren't paid at the business level; they flow down to you personally. So any earnings that you see on your profit and loss, a portion of that is going to have to go towards taxes. And of course, the best part is you can pay yourself. And depending on what entity type you are, the manner in which you pay yourself changes. We'll go into that in a bit. All right, so what the P&L shows and does not show. And this is an area of confusion with a lot of our clients that we see, so I think it's something I just want to clarify. So, as I mentioned, it shows your sales, your gross income for the business. It shows your direct expenses, your deductible expenses. It shows your overhead expenses. And if you're an S corporation, and therefore you have to pay yourself a W-2 salary, it will show the W-2 salary that you've paid yourself. That's a deductible expense. Things that are not on the P&L, and hi Heidi, thanks for joining us.
Hi.
Things that are not on the P&L are any loan payments, right? These are all things that loans are on your balance sheet. These are liabilities that your company owes. So any payments you make against that loan, would actually just go to reduce the loan balance. But actually, Heidi, if you could you mute your microphone just so I don't get some feedback from my own voice? Thanks. And then of course any interest on any loan payments would be reflected as an expense on your P&L. So savings in the business bank account, any transfers to a savings account, right? All that is balance sheet transactions. Investment in inventory or equipment. So So if you purchase a large piece of equipment for your business, we will typically record that as a fixed asset on your balance sheet, and then we will depreciate that over a certain amount of time. So it's only the depreciation that would show up on your profit and loss as a deductible tax expense. So this is probably these bottom two areas here, income tax payments and owner draws are two areas that we see folks get confused with. So again, as a single member LLC or an S corporation are two most popular entity types among our clients. Any income tax payments that you make, so a lot of clients pay taxes out of their business bank account. They pay their personal tax bill out of their business bank account. Those tax payments are not deductible expenses on your profit and loss. So as many of you are probably familiar with, you'll see that Engage, we put those payments on your balance sheet in the equity section, because you're effectively taking an owner draw when you make an income tax payment. So that's a good segue to owner draws. So if you're a single member LLC, as many of our clients are, or a partnership, you're not permitted to pay yourself a W-2 salary, but the way you do pay yourself is through an owner draw. So that owner draw, that paying money out of your business into your personal bank account, is not a deductible expense. It would not show up on the P&L. It would actually show up on your balance sheet. And same goes for if you're an S corp owner, you're going to pay yourself partially via W-2. That would be on the P&L, but the distribution portion is off P&L, would be on the balance sheet. So just wanted to clarify kind of the different components and kind of what statement they would land on. A P&L, a profit and loss statement, income statement, whatever you want to call it, is obviously a universal financial statement. At Engage, we work with small business clients. So whether you're a small one-person business or you're an Amazon corporation, the profit and losses, the concepts are really the same. It's the mechanism for tracking revenue and deductible direct and overhead expenses to get down to ultimately whatever the net income or net profit is of your business. Every P&L for whatever industry you're in is going to look a little different. The same buckets are generally the same, but if you look at like a retail business in comparison to a consultancy, right, or a service-based business, that isn't selling any tangible goods, you will have probably pretty noticeable differences on the P&L as far as the expenses that are shown on there and the amount of cost of goods sold versus general overhead expenses. So all things to consider. We covered kind of some of the basics, but we figured it would be good to kind of look at a typical profit and loss and kind of dive into those different sections so you can kind of see what I'm talking about. So here's just kind of like a general example. Again, on the left is an S corporation profit and loss. On the right is just a sole proprietor, single member LLC profit and loss. Same company, but we're just kind of assuming that, different scenarios of what entity type that company would be. So I'll just look at in this first slide, we're showing total income or gross revenue, and then we're showing the cost of goods sold section. So this business is sort of like a design services business. So, they're in that kind of construction world of helping to design, commercial building designs, architecture, and they also do some product sales of furniture pieces, office furniture and whatnot. So here we have their different kind of sales lines lined up here: commercial sales, design services, consulting income, and then we have those direct costs related to their sales. So that's coating and finishes, fabrication, all their subcontracted services. These are all the expenses that are directly related to the sales that they make. If the sale didn't happen, the expense would not be incurred. So those are the type of expenses, the variable expenses, that we like to show in cost of goods sold. So when you take your And I always like to tell clients, this is sort of like the battleground of every business. This is where the battle is won or lost, is up in this section of the P&L, because this will show you how profitable you are at the point of sale, and therefore how much money is left over after paying out your direct expenses, how much is left over to cover your general overhead, and then of course any compensation, right, that you want to pay yourself as the owner. So in this case, whether you're an S corp or a single member LLC, it's identical. You can see they're both the same picture that we're looking at on the left and right. So just looking through, here's total income of $422,000. Total cost of goods sold is $147,000. So the gross profit margin. Now, when you meet with Mike and I, you always hear us kind of talk about the gross profit margin. In this case, is 65%. So basically 35% of every dollar of sales is basically being skimmed off the top to go pay for your direct costs. So this is, where we'll go into a little bit further kind of like how to construct the P&L. But this shows kind of the importance of being aware of like what we're putting into the different buckets of the P&L, because they can help kind of like inform our decision making and really help us identify the overall health of the business. So if we go to the next slide, so this is gross revenue, cost of goods sold. The next slide is just a continuation of the P&L. This is the overhead portion of the P&L, so the general kind of expenses. So this is all stuff that will be familiar to all business owners here. You have your accountant expense, I guess your friends over here at Engage. You have your advertising and marketing, all your bank charges. Here's where you would have payroll expenses for any employees that you have, insurance and all those kind of typical overhead expenses. Rent, of course, would be a popular one. These are your fixed monthly expenses that, regardless of your sales, whether it's a good year or a down year, right? These expenses aren't, in theory, going anywhere. So that's why we like to put them in overhead. So I'll go back. Well, I can't go back, but I will stay here for the time being. So if we go forward, your gross revenue less your cost of goods sold, your gross profit is the take-home pay from your sales. That's the amount of money that you have left over now to cover your overhead expenses. So in this case, we've got about $81,000 in overhead expenses. And this gets down to basically the bottom line number, the most important number that we're going to have, whether you're an S corporation or a Schedule C entity, like a sole proprietor, is this net operating income. So in this case, you can see it's still identical on each entity type. You have $195,000 as an S corp, $195,000 as the sole proprietor, and this number is that gross revenue less cost of goods sold less overhead brings you to your net operating income. So this is basically the profit that's left over. This is the money that is available to you as the owner to distribute this, to yourself in the form of either a W-2 salary if you're an S corp, or an owner draw if you're not an S corp. It's also the money that, like I said earlier, you have available to pay down debt, reinvest in the business, and of course, some portion of this money should be set aside to pay your eventual year-end tax bill. So going now to the final component. So the way that we like to lay out the P&L here at Engage CPAs for our clients is, if you're an S corp owner, we like to have another section below that net operating income where we show the owner salary. So in this case, we have the officer wages, because as an S corp, as many of you know, you are required as the owner of an S corporation to pay yourself a reasonable salary. You have to pay out some portion of your profits in the form of wages. The IRS requires that because basically they sort of want to get their hands on some payroll tax. So when you pay out wages, it generates that payroll tax. So we work with clients, obviously, to help assess how much you should be paying yourself in salary versus owner draws. Now, on the right-hand side, on the sole proprietor side, there's nothing really below the line, right? Because you're not permitted to pay yourself a salary, so the net operating income just carries forward all the way down to be your bottom line net income. But over on the S corporation side, we start at that $194,000 of net operating income, and then we subtract out the W-2 wages that were paid to the owner, and that gets us to our bottom line net income for the business. So that's sort of kind of some of the differences between an S corporation P&L and then I'll call it a non-S corporation P&L, basically a sole proprietor, a single member LLC, or a partnership if you have two owners. So, so here's a slide that kind of like show kind of the importance of account categorization. So, get to this a little bit further, but as you know, many of our clients, I would say the majority of our clients, take the lead on the day-to-day bookkeeping. So we go in, obviously, periodically. We engage someone on our team. Will go in before the meeting with Mike or I, and go into your QuickBooks and clean things up and reconcile everything before the meeting. And usually when we go in, we'll take a look at the account categorizations, and we'll try to make sure that we think all the accounts are in their proper buckets. You know, that income accounts are in income, and variable costs are being shown in cost of goods sold, and true fixed regular monthly expenses are shown in overhead. But there's still some things that we're not able to catch, right? We don't know your business as well as you all do as the owners of the business. So I just want to highlight, if we don't put the accounts in the correct places, the correct buckets, or the correct sections of the P&L, it can show kind of an inaccurate picture of how things are going. So if we take that same example that we kind of just went over, I'm going to call it on the left the good version, right? The most accurate version of the P&L, and then let's call it the bad or the inaccurate version of the P&L. Over here on the left, we've included, it's the same company example we used before, but we included basically all of the cost of goods sold, right? So we have a full picture of all the costs related to making the sales for this company. So we show a gross profit margin of 30% here, with 70% going out to the direct costs. On the right-hand side, maybe the client did not show all of the cost of goods sold in the correct place. Maybe they put these expense accounts somewhere else on the P&L. So this would show an inaccurate picture. It would make it appear that we're more profitable at the point of sale than we really are. See, in this instance, we're missing the subcontract costs and we're missing the supplies costs. So our cost of goods sold are understated, and therefore our profit margin is significantly overstated. So this would give, like I said, if we're looking at your P&L and trying to make decisions on what expenses we need to trim and what areas we can improve on, this wouldn't be overly useful in that endeavor. I'll put it that way. So if we move down further now, so we go down to the overhead portion of the P&L, you can see on the right-hand side here the job supplies and the subcontracted services that should have been up in that cost of goods sold section are being shown down here in the overhead. So moral of the story is, the bottom line net income for the good P&L and the bad P&L is exactly the same, right? Because the expenses are being shown in the overall P&L, but it's not from a P&L analysis standpoint, it's most helpful if we have the variable costs in cost of goods sold and the regular monthly recurring overhead expenses in overhead. That will give us the best ability to give insights into the health of the business and what areas we need to improve on. So I just wanted to highlight that. So we are motoring through this presentation. At the end, I'll see if anyone has any questions, but just wanted to highlight. So, as I mentioned before, most of our clients, like we said, do take the lead on the bookkeeping. So if you are one of those clients that is responsible for the day-to-day bookkeeping, you probably often will go into QuickBooks and you have to create new account types, right? So Maybe you have some legal expenses this year and you haven't had those historically. Well, you've got to go in and create a legal expense account. Or maybe you've started, you're a photographer and you've begun to start getting some help. So you have like second shooters that come with you to weddings or whatnot. So you want to start recording subcontractor expenses. Well, you have to go in now and create a subcontractor expense account. So when you go into QuickBooks to create a new account, it will ask you what type of account you want to create. So they actually recently just changed the interface for this. So when you go to create a new account, you'll see this little window here will pop up. Here's like a little excerpt of it. But we have the different options you have are income accounts, right? Self-explanatory. That will obviously go to the gross revenue section of the profit and loss. And then you have expense accounts. And when you click on the expense account, well, actually, I'll get to that in a minute because I just want to go through. You can also create a bank account, which a lot of our clients do by mistake, which will accidentally create a new bank account. And so it won't even show up on your P&L. It will show up on the balance sheet. So we often have to go in to correct that. So just be careful with that when you're creating new accounts. You can also create an asset account. Again, that won't show up on the P&L. That would be something for like, machinery and equipment. If you want to record the purchase of a new $10,000, piece of machinery, you would create an asset account. You can also create credit cards. If you get a new credit card, you want to link to QuickBooks. There's liability accounts for any loans that you have, or other similar liabilities. And then there's equity accounts, which is the accounts where we try to capture the activity of you as the owner of any owner draws that you take or contributions that you make into the business, none of which has any impact on the P&L. So the two kind of most important accounts related to the P&L are these two here, the income and the expenses. Now, circling back to the expenses, when you click on the expenses, it will basically tell you where do you want to put this account. So we've highlighted here, it will kind of map out the general structure of the P&L for you. So if this account you're creating is a variable expense that is directly associated with the sales that you make, so like I said, you get a subcontractor that is directly related to your service offerings. That would be cost of goods sold. So you create that account, and then you click on cost of goods sold. That's the family of accounts where you're going to put that. But maybe if you're setting up a general legal account or advertising, that you would just put under expenses. So that will fall under that overhead bucket of expenses. So if you can kind of keep this in mind as you're kind of going out throughout the year, this will help to ensure that costs are being accumulated in the correct buckets of your P&L, so that the final product is the most useful profit and loss that we have to make decisions. One thing I'll highlight is there are tricky scenarios where you'll have, let's say, supplies. Supplies is one where sometimes you're going to have, depending on the type of industry you're in, maybe you're going to have like general supplies that you're just buying for your stockpile of eventual use that you know you're going to need. Sometimes you might need to buy supplies for a specific job. Again, to take that the event example, if you're a photographer or an event rental business, and you're buying certain things for a specific event, right? You could have different buckets of supplies. Some of those would be more direct costs that you only bought because of a sale you were making. And then you could have another bucket of supplies that's more general overhead. So you can get pretty detailed if you want with this, but just want to kind of hammer home the concepts a bit. So that's the fairly abbreviated, as we're about 25 minutes in. So that's sort of the quick and dirty on the profit and loss. So again, as we have your biannual or triannual meetings with Mike and I to kind of go through your numbers, this is something that both Mike and I and the whole engaged team, as we're preparing for the meetings, we'll always kind of we'll look at the profit and loss, make sure that everything is categorized correctly, and we'll make corrections as we can. But if the client is aware of this and looking out for it also, I think it's going to help us as a sort of team effort to get the most accurate profit and loss we can, which is ultimately our goal.
If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.